You wrote a book that predicted the 2008 housing market crash. And I know if we look back over the years, the last couple hundred years, every 2 or 3 years or so, we had a recession. But the Federal Reserve has found ways that can be extended. Now we're looking at 10 or 15 year cycles, and the bubbles are much bigger. So the downside risks, like we saw in '08, become much greater.
We probably are headed for a recession. There's an awful lot of indicators. In some ways, a typical recession, and in other ways, a much more dangerous animal. And that's the thing the governments are terrified of. And that's why we get super low interest rates as soon as there's a hint of a recession right now, because they know it could happen. So we get a recession followed by aggressive monetary easing, followed by financial instability. And there's our death spiral, financial breakdown, monetary reset. I think it could happen as part of this cycle. Gen Z are going to find out that everything can be taken away from you. You can have your bank account almost vaporized and your stocks go down. People are going to take some really big losses, and they're going to learn the Depression era generation lesson that you need to be careful.
So what do you tell people that are wanting to buy a house right now? John Rubino, welcome back to the show.
Hey, Todd. Great to talk to you again.
I want to talk about your thoughts regarding expected interest rate drops by the Federal Reserve and the potential impact to Americans because of the consumer debt crisis, coupled with the lack of cash in savings, the real possibility for additional inflation on life's necessities, and your expectations on home prices over the next year. You've authored and co-authored books through the years talking about various impacts to the U.S. economy, globalization, dollarization, and the housing market, and more. Some call you, John, a Perma bear, and some call you a genius. But before we dive into your expectations of the overall economy and where we're headed over the next 12 months, I've never heard you talk about your childhood, and I'm kind of curious. Can you just tell us a little bit about John Rubino growing up and sort of what shaped your path to where you are today?
Yeah, I had a very lucky childhood. I grew up in a small town in Ohio, 4,000 people surrounded by farms. So it was super low stress. My mom was home and, she was always there for us, which is a huge deal. I mean, if you have the unconditional love of at least one parent, then the world seems like kind of a benign place to you, because when you're getting wired up when you're young, it is a benign place. And so, I grew up in that small town and was kind of a high school jock, which you can do in a small town, even if you're not very athletic. And then got interested in finance by reading a philosophy book by a guy named Harry Browne. And it was something like How I Found Freedom in an Unfree World. And I was like 19 at the time, thought I was a philosophy major in college. But he was also a gold bug investment advisor, Harry Browne was. So I got exposed to that whole way of thinking. Financial crises come when governments get too big and spend too much and borrow too much. And then there's some kind of a monetary reset and precious metals go through the roof. That was a formative experience in my teens for me, because gold and silver did in the 1970s go through the roof. So I got to watch a giant precious metals bull market happen back then. So I was kind of hooked on the whole stock market thing from that point forward, and did a couple of analyst jobs on Wall Street, and then branched out and started writing about that stuff. And for a while, I was a tech stock columnist during the dot-com bubble in the 1990s, and got exposure to that bubble before it blew up. And then wrote some gloom and doomy books in the 2000s about the real estate busts and the coming collapse of the dollar, which took a little longer than expected. But so the Perma bear thing is correct, since I have been telling this same story for a really long time, because the big story of global finance is that we broke our link to the gold standard in the 1970s, and ever since have been operating with fiat currencies, which are basically unlimited credit cards for governments. And they have totally ruined the global financial system by borrowing too much, printing too much currency, funneling huge amounts of newly created currency to the already rich. So we now have an aristocracy in charge of the world, all of that stuff. And that story took much longer to play out than it felt like it was going to. Like, James Turk, who is well known in gold circles as the founder of a company called Gold Money. He and I wrote that book, The Coming Collapse of Dollar and How to Profit from It, in 2004. And our biggest fear was that the global financial system would collapse before we got the book out. We thought it was that close. And so, anyhow, I've been very bearish about the fiat currencies of the world and very bullish on gold and silver ever since. And, it's nice to finally see that playing out. I don't have that many more years probably to do this, but it looks like, based on what's happening in gold and silver and bonds, et cetera, that we're finally entering that death spiral of the fiat currencies, which is the same thing as saying a massive bull market for precious metals. And it's finally starting to happen.
So taking you back to childhood, you had siblings?
Yeah, brother and sister. And, it was one of those things that almost sound like fantasy now, where we would just go out as kids in the morning and we would just play all the way till we got hungry. And so that was basically my life. Lots of other boys my age in the neighborhood. So we just played football and basketball and baseball all day long, and so it was very nice, very easy. Actually, here's a related story. My wife is a counselor, which means she deals with a lot of people that have childhood traumas. And she's astounded that my only childhood trauma was being forced to sit through Catholic church as a young kid, because it was not air conditioned and it was in Latin and everything. And I remember that as being super stressful, but that's it. Nothing else bad happened to me as a kid. So I was a very lucky person growing up. And it wasn't until much later that family stuff started making me question how lucky I am. We don't need to go into that, but
Yeah.
eventually the scales balance, and I got through the first 50 years of my life as being extremely lucky with no big traumas.
So what'd your dad do?
He ran a bar slash restaurant called Rubino's Spaghetti House. It was in Lisbon, Ohio, 4,000 people. And so everybody knew each other. And because he had that bar and restaurant, everybody knew who he was. And it's not exactly the highest status family background, but in that town it was. We were known by everybody because of what my dad did. And that made things a lot easier too.
I went to Ohio, was in Cleveland, outside of Cleveland, I don't know, maybe 5 or 7 years ago or so. And I was amazed at how still kind of like, I'm going to use the term backwards things were, because it was kind of nice. It reminded me of my childhood growing up, like my teenage years. I still saw phone booths and people had flip phones, and I mean, it wasn't the new flip phones either. I mean, it was kind of interesting to see, that it was so wholesome. And but there, I mean, it's a funnier story that I'll just tell it real quick. Me and my partner at the time, we were building houses, so maybe it was 10 years ago. Had to have been 10 years ago. And so we had decided we were going to go to this auction. There's this auction site or auctioneer that travels around the country and selling building supplies. And we would go to this auction and we would literally buy a tractor trailer load of doors and trim and whatever we could get that wasn't, this is before prices became ridiculous and people were overbidding for building materials higher than what you could go to Home Depot and buy it. It became more consumers than contractors. But anyway, so we went out to Ohio, and so we rented this huge truck, and we went to the auction the next morning, and we were like looking at each other like, where the hell is everything, man? This is terrible. There's nothing here to buy. So we went up to the register for the auction, and the lady said, oh yeah, this is our worst one in the country. So we drove the truck back to the rental place as fast as we could and jumped the next flight back to Baltimore. But anyway, but it was fun. So that's cool. Ohio.
Well, yeah, Ohio is part of the Rust Belt, Ohio, Pennsylvania, Michigan, and everything. And they boomed for a long time, but then went into this prolonged decline. They're the big victims of globalization because all of the factory work there was shipped to China and Mexico. And so Ohio still hasn't dug itself out of that hole. And, I don't know how Pennsylvania and Michigan are doing, but, everything's coming back now as we reindustrialize. But Ohio had decades of decline. And then came fentanyl and oxy and stuff like that. So they had this huge drug problem and meth. And so it went from being, the industrial heartland to this kind of post-apocalyptic thing for a while. And, it's really nice to see that part of the country coming back and becoming what it should have been all along. So, yeah,
Yeah.
so here's hoping it continues.
Yeah. Well, John, as you know, I'm a big fan of your work. I've read several of your books. Now you spend most of your time writing on your Substack, which I'm subscribed to. And by the way, I'll drop all of those links to your Substack and to your books in the show notes, sure. But I must tell you, there's sometimes you scare the hell out of me with some of the things that you write about. Maybe we could talk about that a little bit later. One of the articles in particular, but a lot of it we can't even talk about. Some of the topics on this platform for obvious reasons. But like I said, for those that want to know more about John, if you don't know John Rubino, his links are below in the show notes. I hope you're enjoying the interview so far. I just wanted to take a brief moment and let you know that this podcast is brought to you by SachsRealty.com. Here at Sachs Realty, we're committed to bringing you the best real estate education and helping buyers and sellers achieve their real estate goals. If you haven't subscribed to our channel, please consider doing so now. And don't forget, we're on every major social media platform, so you can follow us there as well. Now back to the show. John, so you agree that you're a perma bear. I just want to kind of get that out of the way.
Well, in the sense that I started seeing and writing about the flaws in the current system that is eventually going to lead to a big crisis a long time ago. So I've been chronicling that process of the system breaking down. But nothing would make me happier than for us to solve these problems through a monetary reset or, total restructuring of how governments work and everything. And then be able to go on to looking at optimistic stories out there, like what new technologies are coming along that are going to be great investments, or, what is undervalued because it's doing better than people realize. There will be stories like that out there someday. And I would love to still be an investment writer, but to be able to chronicle positive stories. So yeah, I'm not temperamentally a perma bear, but I've been telling a story that is inherently bearish for a really, really long time. So, there is kind of a broken clock aspect to this that, when and if I'm right next time, it'll have been so long since the last real big crisis that it's more like the broken clock than me being in any way a brilliant observer of what's happening.
Well, I don't think anybody can dispute that the dollar is becoming worth less and less. So let's talk about inflation. There's a lot of talk lately about inflation coming down, but I'm very concerned about the cost of living. As I said, our dollar buys us a lot less today than it did just 5 years ago. And it doesn't look like the cost of living is expected to come down very much. I mean, we are seeing, home prices come down, but I'm talking about other things as well. But can you explain, when the Federal Reserve says that inflation is coming down, that they're really referring to what's known as disinflation? Can you explain that for the audience?
Yeah, disinflation is different from deflation. Deflation is when prices actually drop. Disinflation is when the rate of increase in prices slows down. And that is where we are now. We had, in 2022, double-digit inflation in the United States. And now we're down to 2, 3, 4%, depending on which measure you look at. So inflation, in other words, the rate of decline in the value of the dollar, is slowing. but it's never really been zero, or hardly ever been zero, since 1970s when we went to a fiat currency, and there's no way that it will be for long periods of time zero ever again. We can't in the current system get to stable prices because we've taken on so much debt that the only way for the world's governments to manage that debt is to create a whole bunch of new currency and dump it out into the market. That limits their interest expense on their debt, but that also makes the dollar lose value and makes all the stuff that you and I buy day to day go up. So we're in a place where that can't be fixed, that cannot be changed. We're going to have inflation going forward, and the only question is, when does that become so disorderly that it breaks the system? And we have to just sit down with a blank sheet of paper and create a new monetary system, which sounds crazier than it actually is. We've had monetary resets multiple times, the last time being the 1950s. So it won't be like, you know, digging in rubble to try and find some ideas because we already have the ideas for how to do it out there. And it'll be a question of choosing. Do we want to go back to a gold standard? Do we want to bring Bitcoin into the mix? Do we want to do some kind of a law that just forbids governments from borrowing anymore and control the money supply in that way? That'll be the debate. But I suspect we're close now. That's the kind of thing that might dominate the headlines in a year or two.
Well, I don't. I mean, I don't think Trump just with this new big beautiful tax bill. Elon Musk said you can have big and you can have beautiful, but you can't have both of them at the same time. And I think a lot of people thought that he was just bashing Trump, but I think it was made clear that he doesn't have to agree with everything that has been passed or that is proposed. And I think that that's fair to say for anyone that can think on their own. But I do want to talk about the cost of borrowing money because it has been higher than it has over the last 20 years. And I pull up this chart here, this federal funds effective rate chart, and we can just kind of look at. It seems like the Federal Reserve has not lowered interest rates in this last round. It kind of flattened out here in September, and then in December of 24, they dropped it, and we have not seen any further drops since. They meet again June 17th and 18th to discuss the possibility of the rate change. What can you explain here? I mean, when we're looking at this chart, can you just kind of describe the federal funds rate and what that is, and why is it that it seems like in these gray bars here are recessionary periods, and why is it that it seems like as soon as we go into what is called a recession, by the technical term, they drop rates? I mean, we're not in a recession right now, right? Right? I mean, they're telling us we're not. Why would they consider to drop rates, and why did they do it in December?
Okay, this is a really useful chart because someone looking at it would have some pretty serious questions that definitely need to be answered. First of all, the Fed funds rate is an interest rate on overnight deposits in the banking system that the Federal Reserve controls. It gets to set that interest rate. And the lower the interest rate is, the cheaper money is, and the more likely people are to borrow, and the faster the economy grows. That's the relationship between that rate and the economy. But if you look to the left on that chart, you see interest rates were once way higher than today. So somebody looking at that chart would say, well, we're not in the danger zone. We've had much higher interest rates than this in the past, and we were okay, right? And the answer to that is, yeah, we were okay back then, but we won't be okay this time around because back then in the 1970s and 1980s, we were actually in pretty good shape financially. We didn't have that much debt. And because of that, we were able to use really high interest rates to manage the currency crisis that we had in the 1970s. So mortgage rates went to like 16 to 18% back then, and the economy didn't collapse. Now, the reason why we can never do that again is because in the ensuing few decades, we borrowed insane amounts of money at every level of every major country. And so for interest rates to go up even a little bit from here risks bankrupting governments, corporations, individuals all over the world. If the U.S. now has, well, let's say, to keep round numbers, we're approaching $40 trillion in debt. And if the average interest rate on that goes to 5%, you're talking $1.5 trillion, $2 trillion a year just in interest. And Japan has the same problem. Most of Europe has the same problem. So we cannot raise interest rates from here. And the question is, are we going to leave them where they are, or are we going to cut? That's the debate going on in Washington right now.
But,
Go
well,
ahead.
while you're on that, not to interrupt you, but while you're in that same train of thought, I just want to pull up the CNBC. This article was June 4th. Trump says, too late, Powell must lower interest rates after weak ADP jobs report. President Donald Trump urges Federal Reserve Chairman Jerome Powell to cut interest rates. Trump told Powell in a recent meeting on the economy that he was making a mistake by not cutting rates. And European Central Bank is likely to lower rates again. They have done it multiple times. That would mark the 8th consecutive cut since last June on Europe's central bank, their interest rate. So let's talk about what you were about to say. With they're at a sort of like a crossroads right now. I mean, this June meeting, what would the implications be if they kept the rate the same? Now that we're starting to see negative job reports and some layoffs, I think, trying to think of who it was that just announced 7,000 job cuts. We could pull up dailyjobcuts.com and let's take a look at that. But we're starting to see where, and I think that's what Powell had originally said back when we were going through that COVID period. Powell was saying, hey, it could get bumpy, and Procter & Gamble, that's it, up to 7,000 jobs globally. That was just posted June 5th. So with that being said, and shout out to dailyjobcuts.com. We'll drop the link for them also below. They do a great job of covering, who's laying off, who's closing, and who's hiring. But what would the implications be if the Fed did nothing besides Donald Trump and company being upset, or lowering it? John, what would happen?
Well, one of the entertaining things about Trump is that presidents are not supposed to be allowed to browbeat Federal Reserve chairman in public. That, of course, they always talk, but they always talk behind closed doors when presidents lobby central banks for lower interest rates. But Trump doesn't care. He tweets it out, that he's going to fire the chairman of the Fed if the chairman doesn't cut interest rates. And that's, that's him saying the quiet part out loud, as he does about so many other things. But yeah, that's interesting. But yeah, we probably are headed for a recession. There's an awful lot of indicators. When we talk about housing today, your listeners will see just how brutal the housing market is becoming right now. And then there's commercial real estate and everything. And then student loans are kicking back in. Credit card debt is soaring, and credit card defaults are also soaring. So you got a lot of people putting day-to-day life on credit cards right now and not being able to cover the 25% interest, or not being able to pay their student loans after having 3 or 4 years without having to pay them. There's a lot of that out there that all point towards lower consumer spending in the year ahead, which, because we're 70% consumer spending driven as an economy, that produces a recession. And now, meanwhile, the Fed did start cutting interest rates last September, but they only got to cut the Federal Reserve rate. Everything else, all the other interest rates, went up. So the 10-year Treasury note yield, which is a very big benchmark yield, went up dramatically after the Fed started cutting interest rates, which means they're not listening to the government anymore about interest rates. And that pulled mortgage rates up. So we're back to like 7%. for a typical 30-year fixed rate mortgage, which with house prices being what they are, it basically prices everybody out of the house market. If you have to buy an overvalued house, which with extremely expensive money, your monthly cost is crazy high. Most people can't handle it. So anyhow, so we get a recession. The central banks of the world, not just the US, but all the central banks will then have to cut interest rates aggressively. And if long-term rates won't go down, they will have to go in the market and buy long-term bonds in order to force long-term rates down. And to get the money to do that, they have to just create new dollars and euros and yen out of thin air. So we get a recession followed by aggressive monetary easing, followed by financial instability, because that's going to push down the price of the world's big currencies, which is to say inflation goes up. And there's our death spiral, financial breakdown, monetary reset. So I think it could happen as part of this cycle because we've taken on so much debt. If you look at how much debt even just the U.S. took on in the past 10 years, we came pretty close to doubling our debt in one 10-year cycle, and it took us 220 years to get to where we were in 2011. And then by the early 20s, we had taken on that much debt again. And you can't do that for very long without blowing up the system. And I would argue that we're close to that point right now.
I want to say one thing about mortgages because you're talking about that, and then I want you to explain in detail the correlation between the 10-year Treasury and the mortgage interest rate, because a lot of people believe that the Fed rate is what predicates the mortgage rate. But before you do that, something came to my mind. I want to say it. A lot of people, as we're seeing the housing market soften across the country, and they are coming down. I mean, we just had a podcast with Lance Lambert, has a company called Resi Club. He follows the housing markets, all he does. And he was just on Fox News and talking about the amount of year-over-year price reductions that we're seeing. A lot of people think that they'll just move forward with buying a house. And you said that I think you had just said something to the effect of the overpriced house or whatever. And the danger zone here with this is when you have home prices that are set at 2 and 3 handle mortgages, and that's what allowed them, the cheap mortgage allowed the rates or the home prices to skyrocket. A lot of the loan officers tell people now as they're buying houses, don't worry, you can refinance when the rates drop. If we start seeing further home price declines, you may not be able to refinance, because if the house is not worth your mortgage payment, your balance, then you have to bring that extra money to the table to take advantage of a cheaper rate. So this is sort of like, this is the danger zone that I feel is where we are right now, is that people have this in their mind that I'm not going to worry about that 7% mortgage because my loan officer said that mortgage rates will probably drop, and if they do, I can refinance. You guys need to think about that when you're buying at what I would still consider the top of the market that we've ever seen before in home prices. But can you just explain, John? That little sidebar there, I just didn't want to forget to bring that out. But can you explain the difference between the Fed rate and the mortgage rate? Like, what predicates the mortgage rate?
Okay, well, the Fed funds rate is for overnight lending, so it's super short term. And that might have an impact on variable rate mortgage terms. Maybe that's what gets you down to 4% with a variable rate, adjustable rate mortgage. But for longer term loans, like a 30-year fixed rate mortgage, the financial system keys off of longer term government loans, which is what 10-year Treasury is. So when a bank is trying to price a mortgage, decide what kind of an interest rate they want to give, they look at the 10-year Treasury yield, and then they do a little bit of hocus pocus to get their, they run a formula that gets them to their interest rate given what the 10-year treasury is, and that's the mortgage rate they offer. But it's not just mortgage rates that key off the 10-year treasury. All kinds of other loans out there start with the 10-year treasury note yield and then work their way over to whatever offer a bank is going to make on whatever kind of loan. So it's a very big deal. It's a huge deal for real estate, of course. But
Well, what's the methodology? I mean, if they look at a 10-year treasury and it's 4.5%, how do they use that and to come up with that hocus pocus?
Well, they do two things. They add a premium on top of that. So let's say they add 2%. So then you're up to 6.5%. And then they look at who they're lending to, and they adjust it based on the credit worthiness of the home buyer. So that mortgage might go all the way up to 9% if somebody has really crappy credit, or it might be barely above 6.5% if you've got stellar credit. And it could be something as simple as that, where they just add a couple of percentage points to the 10-year and then categorize their customers and just use whatever bucket you're in to decide what kind of a mortgage you get access to.
But
So
what's that? I mean, even, and I'm sorry to interrupt, but more granular. I mean, why the 10-year treasury? I mean, what is the significance of that as far as the lending rate on a mortgage?
well,
How do they? I mean, is it because they're investing in the 10-year treasury, the banks? I mean, what is the significance of the 10-year treasury bond?
yeah, that could be how the banks do it. They take the money that's coming in, they invest in 10-year treasuries, and that's supposed to offset, the loans that they make. But basically, the 10-year treasury, a 30-year mortgage is much longer than a 10-year treasury. So you wouldn't necessarily think they would have any relationship. But in the aggregate, 30-year mortgages don't last 30 years because people pay them off early. And so you get a typical lifespan for a 30-year mortgage of 10, 12, 14 years or whatever. So that makes a 10-year interest rate a pretty good benchmark, because you're not, in any individual mortgage, you're lending money for 30 years, but in your whole portfolio, you're lending money for a much shorter period of time. And so the financial system has decided that 10-year treasury is a good benchmark for that kind of thing.
I get it. So essentially, the national average for people to sell their home and pay off the mortgage is anywhere from 7 to 9 years.
Yeah.
So
Okay.
they're moving every 7 to 9 years on average,
Which
is
is
what we've seen
that's a
historically
sign of,
since I've been in business.
yeah, that's an unhealthy society when you got that kind of churn in what should be an asset you hold for a lifetime as your main investment vehicle for most people. You get your mortgage paid off and you've got a paid for house, but you never get that if you move every 9 years, right? You just take
Well, you
out
know
another
why?
mortgage.
Because the industry is convincing, especially first-time home buyers, that, oh, don't worry about it. Just say yes. It's just a starter home. So we're instead of we're setting it up. We're setting it up for people to not be happy with their home purchase, which is terrible in my opinion. I teach the exact opposite. Be satisfied with your house and find a place that you want to lay down roots and stay there forever. I mean, how many of your friends' parents, maybe some of them are still living in the house that when you were a kid, right? I mean, they're still there.
Well, that used to be how you
50,
did it.
40, 50 years.
Yeah. I mean, you got your mortgage paid off, and then you had a mortgage party where you tossed that
Yeah.
mortgage into the fire and everybody cheered you for being a free and clear homeowner. But yeah, we don't have anything like that anymore. And I shouldn't criticize, because my wife and I did basically that. We bounced from house to house over the years. And, each house appreciated a little bit. So we made a little bit of money when we sold them. But if we had just stuck with the first or second house we bought, we would have a serious chunk of paid off real estate right now. We'd have something that's super valuable. And so we kind of missed out on that by bouncing around the way we did. But today's society encourages stuff like that. See, that's a lesson we're going to learn, though, Todd. The next generation. How the Depression generation had really thrifty attitudes, because they found out that you can lose everything, and they never wanted that to happen again, and that's how people stayed in houses for 30 years. Well, um, Gen Z in the US will be people who learn that lesson again. In other words, people who are 19, 20, maybe up to 30 right now are going to find out that everything can be taken away from you. You can have your bank account almost vaporize, and your house turn out to be way more maintenance than the actual value as when things shake out, and your stocks go down, and your bond portfolio that was supposed to be the safest part of your asset portfolio turn out to be the worst part. All of those things are liable to happen to people now, and they're going to learn the Depression era generation lesson that you need to be careful, because the world is not a benign place financially where you always get bailed out. In fact, it's the opposite. It's the kind of place where even if you think you're being cautious, you're not actually, because you're listening to people who learned the wrong lessons of the past and who are steering you in the wrong direction because of that. So there's no help for most people, because most people just don't obsess about this stuff the way you and I do, Todd. So they never reach the conclusion that they need to be super careful starting right now. They need to become preppers, and some people are there now, and they're the ones who will probably, in the aggregate, end up in best shape when all of this shakes out.
You wrote a book years ago that predicted the 2008 housing market crash. And I know, as you describe it, you were early, and it's very hard to predict these financial trends, partly because we keep kicking the can down the road. That extension, I mean, if we look back over the years, the last couple hundred years, every 2 or 3 years or so, we had a recession, a corrective period. But since we have found ways, not me or you, but the Federal Reserve has found ways that can be extended. Now we're looking at 10 or 15 year cycles, and the bubbles are much bigger. So the downside risks, like we saw in '08, become much greater. But you and I have been talking and monitoring the housing affordability crisis for several years now. I want to, I want to pull something up real quick, John. I just want to listen to a couple clips. I had mentioned Lance Lambert. He's a contributor to our channel too, being on Fox News. I just want to listen to a couple clips here real quick.
Not a day goes by, right? I mean, warnings and concerns about the housing market, they're mounting. Now, this morning in my inbox, Political called this situation a lose-lose. And, well, there have been even more sensational headlines like this one from the Daily Mail saying that realtors have hit the panic button. Now, some parts of the market, the housing markets, have already crashed, folks. I mean, second quarter of 2025, what they call the vacant property zombie report, 1.4 million residential properties. That's up big time, 1.3% of all U.S. homes. So they're vacant, right? They're zombies. 13 consecutive quarters. Well, this number has been around that level. So then, of course, this morning, we learned that mortgage applications were down yet again, third week in a row. Now, part of the problem is that there are now a lot more sellers. Look at this chart. This is fascinating. A lot more sellers than buyers, all right? 1.9 sellers, 1.45 potential buyers. Now, my next guest has the best insight that I've seen on the street when it comes to these numbers, and really the nuance of these numbers. I want to bring in our Resi Club co-founder, editor-in-chief, Lance Lambert. Lance.
Often the growth markets are the ones that get the corrections, or the deeper corrections. And so what occurred during the pandemic is those markets saw prices go up more. They had a lot of people move in. And also, they have just more new construction. And so as that migration is, less of it's coming in, so they have to rely more on local incomes, that's created a demand shock, a greater one there. And the builders, for multifamily and single family, they have to move that product. They're going to sell it. So if they have to discount it, do big buy downs, do whatever they need to move that product, they'll do it. And so it creates a cooling effect on the resale market as existing home sellers have to compete with the builders.
But you sound confident that it won't get worse. Like, it sounds like...
Well, there's downside risk in this market.
Okay.
Prices can fall.
So yeah, we're starting to see where that, you and I have been talking about this for a couple of years now, and we were hearing the exact opposite in the news, and we were sitting there going, there's no way this is sustainable. I mean, with all the housing related costs skyrocketing, insurance, taxes, repairs, replacement costs, everything going through the roof. So Lance, he says that, well, we know because we have multiple videos, but just a few months ago, about 30 of the 300 major housing markets in the U.S. were reporting year-over-year price declines. Then last month, there were 60 markets in decline. And now in our recent video with him, he says that he expects 140, 150, or 160 of the 300 big housing markets to be in year-over-year price declines very soon. So what do you think? Because I've taken a lot of criticism, a lot of heat. I could go through my comments and tell you about how people say that I'm a perma bear. and then I've been saying the same thing like a broken clock for the last 3 years. And you know what? They're right. And I've always said that I've stayed true to it, saying that this is not sustainable. I just believe that. It's not because, why would I say that in my own business? Why would I tell people that I think that the house prices are going to fall when I'm in the business that makes money when we sell houses? It makes no sense. But what do you think, John? What's your opinion now?
Well, Todd, I think you saying bearish things about the housing market gives you extra credibility because, like you said, a housing boom is where you would make the most money, not a housing bust. But yeah, we are looking at a classic housing bust right now because the way it typically works, in very general terms, is home prices go up and up and up, and they get to the point where they're unaffordable. The average person can't buy the average house. And then sales really slow down because you can put your house on the market at current prices, but nobody can buy it. So it just sits there. And then sellers start to get worried. And so they cut their prices a little bit. And maybe they cut their prices a lot in some cases. And that affects comps. In other words, houses become less valuable across the board once a few sales at a discount happen. And that spooks everybody else who's kind of on the fence. Maybe they could sell, maybe they don't feel like selling, they start to dump their properties on the market until you get this huge imbalance. Lots more houses for sale than there are buyers out there. And if you're going to sell a house in that kind of a market, you got to be seriously motivated. You have to cut your prices dramatically. And then you get this waterfall decline where sales pick back up, but it's because people are cutting their prices so dramatically. And you see prices drop. In the last bust, which was a very big one, admittedly, but there were 30, 40, 50% price drops in a lot of markets. And when you think about that for a house, which is a leveraged asset, say you put down 20% and you buy a house, and it drops by 20%, and you lost your whole cash investment. The money you put into that house is gone because you only put 20% in. So that causes basically chaos in the housing market when people are just, okay, just get me out at whatever, I don't care, and then you get the kind of waterfall decline in home prices and a spike in deals as people start coming in, vulture investors and people, looking to get a good deal, and they have an understanding of what the actual real value of a house is, so they're willing to take some of these offers. That starts happening, and then the housing market eventually flattens out at much lower prices, and then normality can return. But in the meantime, you have a recession because housing is such a big part of the overall economy that when you have a housing bust, it's really hard to have a growing economy. And in our case right now, housing, even though it's pretty much a classic bust, emerging right now where prices are going to go down, people are going to take some really big losses and it's going to make them feel dumb and poor and they're not going to spend as much money. That's just one thing that's happening. You got commercial real estate that is at least sections of it that are going bust, and you got people, as I said before, people with credit card debt and student loan debt, and you've just got a ton of different sectors out there that are all in some kind of trouble. And housing might follow that, or it might lead the way. There's no way to know what happens in the next 6 months, but or you could have them all fall at once. And there's no way to know except that it almost doesn't matter unless you're in one of those specific markets. But if you're somebody who's trying to decide whether to short the stock market, or whether to buy gold and silver, or whether to buy a starter house, even though you can afford a bigger house, if you're just not directly connected to these things that are going bust, then it's not that big of a deal for you. You can sit back and watch it all happen. But if you're in the middle of something like this where your job depends on home builders or something like that, then you have a really serious problem. And there's an awful lot of people who are in that kind of a situation because you can't go bankrupt and get rid of your student debt in that way. You have to keep paying it off no matter what. So if that is the case for a lot of people, then they have to rein in their spending. And then all the people who are benefiting from that part of the consumer spending complex, they lose their jobs. And so that's kind of what we're looking at. It's in some ways a typical recession, and in other ways a much more dangerous animal because we have so much debt. So we could have a recession and an equities bear market, and instead of everything bottoming and us going back to normal, it could just metastasize. It could just roll us over into a 1930s style depression. And that's the thing the governments are terrified of. And that's why we get super low interest rates as soon as there's a hint of a recession right now, because they know it could happen and they want to lean against it immediately.
Yeah, I just had an economist tell me that the Fed is more afraid of a recession than they are inflation. And that pretty much sums up what you just said.
Yeah, because a recession is immediate. People get laid off and they point at you. They know you did that. Inflation is more gradual. Okay, prices drop or prices go up by 3.5% instead of 2.5%. And hardly anybody notices that. And so you can get through the last part of your career, if you're a Fed governor or something like that, without being labeled this generation's Herbert Hoover, if you generate slightly higher inflation each year. But if you let a big recession happen that metastasizes into a depression, they know who you are and they blame you for it. So yeah, the government is much more afraid of deflation than inflation. And you'll see them act accordingly.
So what do you tell people that are wanting to buy a house right now?
I say if you could wait a little while, you might be in much better shape because your dream house will get 30% cheaper over the next 2 or 3 years if we have a normal housing bust. And there's every indication that we do. So if you can wait, of course, that is not an always easy conversation to have with your spouse. I have a friend who talked his wife into not buying a house in California like a decade ago. And it's, they've had that conversation over and over again. He's always said, no, housing is going to go down. And so he finally had to bite the bullet and buy a house for his wife.
I thought you were going to say they finally divorced.
Well, she was a very patient wife, and she got rewarded with a house at the end of all of it. But yeah, because it's not always easy to rent when you feel like you should own.
And it is hard to time the market.
Mm-hmm.
I mean, it is hard. I mean, it's if somebody, I can't tell you how many people I've heard, man, I wish I would have bought 3 years ago or whatever because the prices kept going up or, in my market and things like that. But, you have to make sure it's the right time to buy too. And where we see a lot of these buyers, and I'm not one to say, don't buy a house. I don't say that, but I always say, let's consider your finances, consider your job market. How stretched are you? Are you wanting something that pushes you to the maximum amount that you could borrow to where you're enslaved to your house payment or to a repair or things like that? So, I think that if people can, be wise about buying and making sure that they have money in the bank, that's a big part of it. But John, I want to talk about, for kind of wind us up here, I want to talk about your Substack because you talk about a lot of very interesting things. And though I hear what you're saying, it's not easy, you say things and it seems like it takes a decade for them to play out. But we are seeing a lot of what you've been saying really play out. I think we just experienced a big run on silver. And gold, I mean, look how that has gone up in the last 12 months. I mean, I think, 33 or 35%, maybe if you were bought at the best case scenario to where it is sitting today. But what concerns you most? I mean, out of the things that you write about, I mean, what are some of the things that really just kind of stick out in your mind that really say, man, this really sucks moving forward for our kids?
Well, a currency crisis is bad for lots of people, especially the people who trusted the government. So if you got your kids' college fund in bonds and tech stocks and cash or something like that, and then we have this bout of inflation that makes bonds and cash worth only half of what they were when you put them in there, then yeah, that's very tough, and that's what's staring a lot of people in the face, and it's hard to know what to do about that. Um, However, there's another category of people that basically the gold bugs and the preppers who have seen this for a long time coming and have been what they call stacking, where you just buy a few more silver coins until your stack gets really big. And this has been kind of a brutal 10 years for those guys. And I include myself in that group. And we have been, buying our gold and silver while gold, bounced off 2000 and back down for a really long time, and silver didn't go up at all. Meanwhile, tech stocks were going through the roof, and Bitcoin is $100,000, and house prices are through the roof. And so we suffered by being too early with all of this. But now it's paying off. Now gold is just rocking. Gold now, over the last 3 years, has outperformed stocks and bonds. So it's the best performing big asset out there now, finally. And silver is starting to outperform gold. So the people that were too early into precious metals, but have now accumulated quite a bit of it, are among the best performing investors in the world right now. And the reason that gold and silver looked so good back in the day is that we were clearly blowing up the fiat currencies. The dollar was clearly going to be inflated away. And historically, going back 3,000 years, when a government does a stupid thing like that, gold and silver turn out to be the places where you make money, or you at least protect your capital. So assuming 3,000 years of history wasn't going to be debunked or discredited in the next few years, gold and silver were the place to be. And they have turned out to be that way just lately. We'll see where we go from here, but I think previous precious metals bull markets have a pattern, and if this bull market in gold and silver follows the same pattern, they go through the roof from here. And so I'll go out on the limb and say $100 silver. It's $30 some an ounce right now, but $100 silver is very easy to envision if the past is prologue in precious metals. So anyhow, that was a long answer to a question that was could have been answered more quickly, but.
I think to your point, there are a lot of people. I wish I could say that I was one of them that with precious metals, but what that bought years ago, right? I mean, I'm still sitting there going, do I really want to, can I imagine myself spending $3,300 for a little thin mint sized piece of gold? I mean, it's like, you could have millions of dollars in your jacket pocket, right?
Yeah,
I mean,
it's good. Well, see,
it's hard to, as somebody that invests in real estate, like, I like the building that I'm in right now. I like commercial real estate way more than residential. I like commercial real estate myself, and people go, you're crazy. Commercial, the right commercial. I like industrial, things that are, could be medical use and things like that. But what about AI? What do you think about AI? Does that worry you at all?
You were asking before about things that worry me, and there are some serious black swans out there, because what we're talking about is basically financial cycles that are understandable. They've happened in the past. We can draw lessons from history and know what to do. And in that sense, they're not that scary. They're just investment theses that might make us a lot of money if we play it right. There's a bunch of other stuff out there that I don't have an answer for. And AI is one of them. We're apparently close to something called AGI, artificial general intelligence, which is basically a mind capable of learning new things and growing and everything. And, why wouldn't something like that just take off and expand exponentially and become superhuman? And at that point, our existence depends on its goodwill. We won't have anything to say about it. That's a hell of a black flag right there, or a black swan. And then what if some entity in the world gets the first version of conscious AI? For instance, China, let's say. Do they automatically rule the world? Maybe, because an AI that's capable of improving itself would be capable at some point of breaking any encryption. That means they could get into any bank account, they could get into government accounts and the missile launching codes, and you name it. It's accessible to them, and whoever owns that kind of an AI is the new ruler of the world. What happens if we just wake up one day and that's, maybe it's not China, maybe it's the CIA? Would that be better? Maybe not, and so we have to see about that. And then there's all kinds of military things that spook me, because what if the US and China get into it and the US loses the first battle? What would that do to US stock market and pretty much every other markets here? I think it would probably be good for gold and silver, but for a typical stock or bond portfolio, it would be catastrophic. We would just panic. And that would be a huge financial crisis for the US, because then we wouldn't necessarily be the world's only superpower anymore. We wouldn't be able to defend the dollar. The dollar depends in a lot of cases on the US being able to back it up militarily. So take that away and boom, massive financial crisis. And then, there's always the next pandemic or something like that, or a solar flare. There are things that happen occasionally, and if they happen in a certain way, they're catastrophic. And so statistically, even if things like that are a 1 or 2% chance in the next 5 years, if you add 20 things like that together, you get up to reasonable odds that something happens like that. And because of that, you shouldn't ever be certain about an investment thesis, because things could happen that throw everything up in the air and make whatever you thought was going to happen much less likely. And so that's why real assets are better than financial assets in this kind of a world. If you have in industrial real estate, like you said, it has a function, it has a use. And so it stays valuable even if the financial markets are in turmoil. Same thing with gold and silver. They function as money, and farmland, and a really well-chosen rental house, oil wells, things like that. They will tend to do better in a world of uncertainty than financial assets like cash under the mattress or a bank account or a bond fund. And I think in today's world, you want to be skewing towards real stuff, like what you own and what I own, and away from what a typical person might have if they trust the government.
Yeah, well, like I said, I get those, some of what you just kind of described. I love reading your Substack, and you make a lot of sense to it, and you also provide resources for people as well. So I always appreciate, sir, that you come on and talk to our audience, and learn a lot from you. Thanks so much, and we'll get you back on here sometime real soon.
Thanks, Todd. Look forward to it.
Thanks so much for watching. If you liked the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.